Let's bring in David McIntosh, president of Club for Growth. He's usually inside the Beltway. It's good to see you here in New York. I'm sure you're glad to get out of the sausage-making capital. This tax bill was supposed to reduce tax mandates, not create new ones.
No, exactly. Effectively, this is a small capital gains tax increase, which is against the growth effort in the whole tax bill. It's a dumb provision. The Senate tucked it in, hoping to get a couple billion in revenue.
It's called, by the way, first in, first out. I think we can put up a full screen about it. What it is essentially doing is mandating that if you have, say you bought Apple at $30, you were really lucky and you bought it at $300, you have to sell the $30 tranche first. Because that's the part that will give the government most tax money.
You're exactly right, David. It really hurts people who have been buying stock all their time, and that's their retirement. Because as the stock price has gone up, they're going to get hit with much higher taxes. Ironically, the swamp exempted the institutional investors.
Let's talk about that, because this is, some people say, is a pure example of the swamp at work, the Beltway swamp. Exempted from this proposal for individual owners of stock like you and me are the mutual funds. The mutual funds themselves, clearly the mutual fund lobby got into the rulemaking process, and they convinced, maybe based on donations or whatever, certain senators to go along. So the mutual funds are exempt from this, but their individual clients are not. If you want to sell stock on your own, you have to do it this way. If you're a mutual fund, no.
That's right. It's terrible for individuals. In this conference, they should just extend the exemption to everybody. People who buy stocks on their own, people who buy mutual funds. And then they won't be doing, essentially, a capital gains tax increase.
And just to add something new, I mean, could the new tax bill itself end up being at least, if not more complex than the tax bill we have now?
Yes, you can't call it simplification anymore. They're expanding the number of brackets. They have a hidden marginal rate for the highest taxpayer in the House bill. What they need to do is keep the corporate rate at 20%. That's tremendous.
You think they will?
Great growth. I do think they will. We've signed a letter, 30 other groups have signed a letter saying keep that at 30. We've also told them keep the lower Senate rates on individuals so that when SALT's gotten rid of it, the pain's not that great because they've lowered the rates. And frankly, what they need to do is focus on what's going to grow the economy. It's a good bill now. It could be even better.
Well, I don't know if I call it a good bill, but the bottom line is I'm for anything that cuts taxes, because I think government's getting too much of our money as it is, and it's better in the hands of the private sector. Will it at least do that? Put more money in the hands of the private sector.
$1.5 trillion will stay in the private sector. People can invest that, and that's what will grow the economy, create jobs. $4,000 for the average take-home pay will be increased their annual salary.
And will it pay off in time for the 2018 midterm so that the Republicans maintain a House and a Senate?
Well, this is where their little gimmicks start to come into play. If they kick it in January, it'll help. Everybody will give credit to Donald Trump. But they're tempted to say, let's wait a year, maybe then we can play around with it some more. That would be another dumb idea.
All right, there were a lot of dumb ideas in D.C. David McIntosh, great to see you.
Great to see you.
Thank you very much for being here. Melissa.